I know what you're thinking. Where have I been? Well, I hurt my back in the beginning of the year, and I've had a 2-month ordeal of pain, and I'm finally been over it over the last month, so every day I'm grateful for not being in pain. Today is Saturday, March 28th. There's so much going on. It's just absolutely wild right now. We're in the grips of the COVID or coronavirus, whatever you want to call it, and I'm sure you're sheltering in place. I hope that you're okay. I hope your family's okay. I want to talk a little bit about what's going on in the mortgage market right now, because it is crazy. There's 2 words to describe what's going on: volatile and chaotic. Some other folks may say uncharted waters. For 34 years, I've been telling you, watch the Treasury, watch the 10-year Treasury, because it's an indicator and highly correlated to what goes on in the mortgage-backed securities, further what known as MBS. And it's easy for consumers and you and I to see what's going on in the 10-year Treasury. It's easy to find on the internet. And as I've told people, you watch the direction, not necessarily the specific value. Well, what I've been telling you over 34 years is decoupled, is not true anymore. The mortgage-backed securities and Treasury bonds are totally decoupled at this time. So here's the yield on the 10-year Treasury. In the beginning of the year, we were at 1.874. March 5th, it hit a low of 0.66. When the 10-year Treasury broke 1, I got scared. Normally a mortgage person would be thinking, Yahoo, Yahoo. But I knew having a 10-year Treasury below 1 was going to have some significant impact. Here's mortgage-backed securities. The 3% mortgage-backed security. We go over here, let's just pick a day. This is January 21st. It opened at 101.73 and it closed at 101.72. Minor volatility within the day. Normally this thing has maybe 0.125 to 0.25 change. If you look at the size of these candlesticks, this is called a candlestick, these are really small. So there's not much volatility going on. Now come over here, March 9th. These candles get bigger and bigger and bigger, which means the volatility is exploding. This is a tremendous change. Now you'll notice that the price is going up, which means that the rate is going down on mortgage-backed. However, you still can't get people to buy them. The only reason this is going up is because the government has infused so much money recently. The takeaway of this is the tremendous volatility. If it starts out here and then it goes down here, that's a 3-point swing or 300 basis points. Normally, you're looking at 12 to 25 basis points in a normal day. When the price is up here, your pricing on your rate sheet is good. When the pricing is down here, the pricing on the rate sheet is bad. The other thing that I want to show you is right here. Now, this is very significant. So what this is showing you is the spread between the 10-year Treasury and the mortgage-backed securities. So back here in 2009, it was high as almost 3. It has jumped recently to 2.65. It's come back over the last few days, but when this spread widens, what that's saying is people want treasuries and they don't want mortgage-backed securities because they're having to pay higher rate in order for people to buy mortgage-backed securities. Nobody wants to make a secondary market in them. And what I mean by secondary market is when we do a loan, that's the primary market. And then when the loan has to be sold and packaged into bonds, that's the secondary market. Secondary market right now is in turmoil. One of the big reasons why is because of forbearance. And what happens is if you package up all these mortgages and put them into a bond and then try to sell them, the people that buy the bonds don't want them right now because they think that they're not going to get paid. We have over 3 million people filed for unemployment. The previous record was about 650,000. They're especially problematic with this forbearance issue for government mortgages such as FHA, because on FHA, the servicer has to pay the money whether they received it or not. And how long can they continue to pay the principal, interest, taxes, and insurance if the loan is in forbearance? So that's why they're a little hesitant to buy servicing right now. And that just creates havoc in our marketplace. So I hate to be the bearer of bad news, but it's reality. Secondary mortgage market is in turmoil because of it. The other thing that you've probably heard recently was, oh, the Fed cut to 0. Well, as I've been telling you forever, the discount rate does not affect 30-year mortgages. The discount rate is an overnight rate that banks lend money to each other. Now, the only mortgage that it does affect is if you have an equity line and it's tied to prime, because prime does go up and down with the Fed funds rate. And right now prime is 3.5. So if you have an equity line, the rate on your equity line will come down because the Fed cut. But it does not impact 30-year mortgages. Okay, the mortgage-backed securities impact 30-year mortgages. So what happened when rates went down? Well, we had a flood of business. And even before the coronavirus thing, lenders just got so overwhelmed with volume that they had to put on the brakes. How did they put on the brakes? They raised their prices. Now, there's another problem of unintended consequences of the rates going down. Remember those bondholders I told you about? Well, if they bought older bonds and now people are refinancing, they're not getting the yield that they thought they were going to be getting. So if they bought a 4 or 5% mortgage-backed security and now everybody's refinancing, they're having to lend their money out at a lower rate, and that doesn't make those bondholders too happy. In addition, when you're putting your mortgages into a mortgage bond, there's different coupons. So the higher the rate, the more the rebate. Well, if a mortgage bond is paying a rebate of 101, which means 1 point back to the lender, and then that mortgage only stays on their books for 3, 4, 5, 6 months, they've paid out 101 and now they're having to pay back their money. They cannot recuperate that 1% rebate that they paid you for sending them those bonds. So that's another reason that the mortgage-backed security market is in a little bit turmoil right now. And again, I'm just going over this in a high level method so we don't get too deep into the woods to try to explain to you both sides of this picture. The other thing that's going on that I want you to understand is regarding non-QM loans. What is a non-QM loan? QM stands for qualified mortgage. So if it's a QM loan, those are the loans that go to Fannie, Freddie, FHA, VA. It's your standard normal stuff. But you've probably heard about bank statement loans or niche loans or loans that will go with high ratios. That's non-QM. That has totally disappeared. If the lender is still in business, they've suspended doing loans. All of that stuff is gone. Even jumbo loans over the agency high balance limit are getting sketchy right now. So, as I said before, the market is in turmoil, chaos, volatility, but those non-QM lenders are either suspended or gone. We had one real estate client that had 3 transactions fall apart because they were non-QM loans. Okay, so now a little bit more news, and please don't shoot the messenger. On February 12th, the Dow closed at 29,551. On March 23rd, the Dow closed at 18,591. 37% loss in 6 weeks. I think most people are feeling the pain of that, especially people that are close to retirement and people that were saving up for their down payment now have 37% less. This is the stock market. 29,551 back in February 12th, 18,591 here. Tremendous loss in such a short amount of time. It's psychologically very challenging, maybe more than challenging. We've since recovered a little bit of room on the Dow, but we still have a way to go. Bottom line, things are stressful on many fronts. Thank God that we still have Fannie, Freddie, VA, and FHA. And the true jumbos, as I said, are sketchy. There's a tremendous volatility. Prices change dramatically within a day. So this is just some crazy times. And for you folks that are old enough to remember the gas crisis, we had to wait in line for gas and we thought that was bad. And then we had 9/11 and everybody was scared in the country and that was bad. Then we had the 2008 financial crisis, and that impacted a lot of people's lives and certainly the mortgage business. We changed forever after that. So be grateful for something every day. Listen to some new age music or smooth jazz or whatever it is that keeps you calm. I'll give you a virtual hug, but I'll stay 6 feet away. Thank you. Give us a call.